So stock price is present value of future cash flows. There are two important terms an investor has to know. One is present value, second is the cash flow. Let's say you have 100 rupees and you deposit in bank fixed deposit at 8%. The value after 1 year would be rupees 108 and it is called future value. And the 100 rupees you are holding is called present value of rupees 108. So any company, after they make sales and after they reduce all the expenses and once tax are paid, it is called profits or earnings. The issue with profits or earnings is that it can be manipulated. For example, in order to increase sales, the company may sell some products on credit. That will result in increased profits, probably for that quarter. What if the person you who to whom you gave credit defaults? That means it will reduce the profits in the future. So in order to avoid all these shenanigans, so what a fund manager does is he or she takes into consideration amount of cash that can come out per share. So let's take scenario one. So year zero is the present year. And let's say the company has reported cash flows of rupees 91 per share in that year and gave a guidance that it will grow by 10% for the next 10 years. So from 91, it will be growing to 100 and 100 to 110 and so on and so forth. And the year 10, so the cash flow that will be coming out per share would be around 236. So in order to get 100 rupees after 1 year, so we need to deposit 92 rupees 60 pice in a bank fixed deposit at 8% per annum. And to get 110 rupees after 2 years, so we have to deposit 94.3 rupees at 8%. So similarly, we have to invest 109 rupees 20 paisa. So for 10 years at 8% per annum to get that 236 rupees. So in order to get a similar cash flow in a fixed deposit, we will have to invest around 1007 rupees. So therefore, the fair price for this share would be around 1007. Simply put, so what is the amount of fixed deposit which we have to do to generate the similar cash flows over 10 years? And the price to earnings would be around 11.08. That is 1007 divided by 91. So we assume the earnings to grow at 10%. So in this scenario, that means the share price after 10 years would be 2612. This is the ideal scenario, right? So, and let's take scenario two. Here, an analyst assumed that the growth would be only 5%, contrary to the company's expectation of 10%. So the fair price, if we calculate, that will come around 781 rupees. And the PE at this price would be around 8.59. So after 10 years at a growth of 5%, the share price would become from 781 to 1272.4. But what if you invested at 1007? You'll be making an annualized return of 2.37%. Ideally, a share price has to follow the earnings. So since you have overpaid, the PE got derated from 11.08 to 8.59. That is at an annualized rate of negative 2.5%. That means somewhere the share price has to correct and grow by 5% or grow at only 2.37% constantly for the next 10 years or remain flat for few years. And when the share price is at the ideal price, it will grow by 5%. The latter is called time correction and the former is called PE derating. Now let's look at scenario 3. Here an analyst assume growth rate of 15% and the fair value of the share accordingly would be 1305 rupees. The PE at this point would be 14.36. So after 10 years, at 15% growth rate, share price would be 5,280 rupees. What if you invest when the share price is at 1,007? That would result in an annualized return of 18%. This happens when most of the investors believe that the company can grow at 15% instead of 10%, leading to increase in PE from 11.08 to 14.36. This increase in PE is called re-rating, This will result in a higher returns compared to the earnings growth. This is what a great fund managers actually do. So scenario 4, it is an extrapolation from scenario 3. Assuming the growth to be at 15%, the fair share price value would be 1305. So what if this stock was derated, assuming that everybody assumed that it would go only by 5, 5%, and you got a chance to invest at 781. And through your research, you expect it to grow at 15%. That means the share price in 10 years would be 5,280, resulting in a whopping 21% return. This is what an extraordinary fund manager do. Try to find derated stocks which have potential to grow at higher rates, and during such phase in the journey eventually get re-rated. To conclude, share price return is a combination of earnings growth, and PE re-rating or de-rating. Let's look at this in Indian scenario. So post-COVID, entire world was reeling under high inflation and low growth, and India was lone bright star, and earnings were growing at a rapid pace. As a result, the entire country got re-rated. So the factors that gave thrust to growth was huge government capex spends, and households were also spending in a great way. The capex spends actually came down in the last financial year due to elections. So compared to this financial year due to elections, and compared to last financial years, the government spent only 62% by December, which was at 67% of the budgeted figure. And the second reason was the household leverage has increased, and that resulted in RBI raising red flags, and at the same time, since the leverage is at a higher pace and the government spend has slowed down, and even the household spend has slowed down. So this resulted in the earnings slowdown. Apart from this, there was an incessant selling by the FIS. This also aided the fall. The reason was, one is like the strong dollar after Trump returned, and he threatened a lot of tariffs, and the other aspect is the cheaper China trade. So especially after DeepSeek, and after President Xi has met the business leaders, now people think that the Chinese market is good to invest. And moreover, to be fair, many people were actually expecting this to happen for a pretty long time. The reason being, at one point of time, India Nifty PE was trading over 25. So the long-term average has been around 18, 19. But again, few fund managers say that there is no way that India is going back to that level. The reason is there are a lot of changes which have happened in the last 10 years. Since most of the people were expecting the earnings slowdown to last longer, there was a sell-off in the market. That resulted in the correction from 26,200, which was a 52-week high. Now presently we are at around 22,000. Now there is a second camp which believes in the contrary. So one is the capex announcement by finance minister in the budget. So even though the government has reduced the actuals, it is expected that the government will spend over 1.05 lakh crores compared to 90,000 crores government was spending before the general elections. And the government has reduced the tax for the individuals as well. That would result in 1 lakh crores in the pocket of Aam Aadmi. And it is expected to spur the consumption. Once this happens, right, people are expecting the private capex also to kick in. And most fund managers expect that it will be visible in FY26 Q1 results. And finally, there is a contrarian view with the Trump tariffs as well. So India typically imposes around 2% on around 9.5% on the goods from US imports, and at the same time, when India is exporting to US, the tariffs that are being levied are around 2%. That means a delta of 7%. But rupee depreciated by more than 4% since Trump came to power. So that means, like, whatever India is exporting, the price increase would be around 3%. That is the worst case scenario, because he has not yet imposed it. So probably this is a ploy on his side to bring India onto table, and so that India may reduce the tariffs on the American goods as well. And many fund managers feel that what India is exporting is essential. So even if there is a price increase, people may buy it. So, and the expectation is that it will not impact the earnings of the companies. And to finally conclude, so for an investor who has planned goals and asset allocation, all that matters to him or her is investing in the right asset class, which is compatible to her risk profile, goals, and time horizons. So this video is made for educational purpose only, and it is neither a recommendation to buy nor to sell any asset class in discussion. Thank you.